Well, I think it does illustrate the Fed's nervousness about the economy. The Fed is trying to err on the side of caution. The quote from the release was they want the banks to adopt prudent measures to preserve capital. The Fed looked at 3 stress tests in terms of the economic scenarios, a V, a U, but the one they're most worried about is a W. The W would be triggered by a second wave of COVID-19 in the United States. And it's a scenario where, in their example, unemployment goes up to 19.5%. If that occurred, the major U.S. banks could see up to a $700 billion hit in loan losses. And I think the Fed wants to make sure that the financial system is in strong shape going into that. And that's really why, as you've mentioned, they've limited dividend increases and buybacks until the fourth quarter, though we think buybacks really aren't going to resume strongly till next year.
I mean, it seems like a very prudent approach from the Federal Reserve and appropriate for capital preservation in an uncertain economic environment. But how does it now change the opportunity in financials for investors, given we've already come a long way for markets?
Yeah, that's very true. I'd say that banks have been driven recently by 2 things. The first is regulation overall has been getting easier for them. Last year, they changed the restrictions on prop trading. This year, they've allowed them now to invest in venture capital firms. They're also eliminating the requirement that banks hold margin when they trade derivatives with their own affiliates. That could free up to $40 billion in capital for the Wall Street banks. And I think entering earnings season, investor expectations are very conservative. I think it's a good chance banks will be able to beat these lowered expectations. And that's really driven by a couple of things. Trading has been better in the quarter. Issuance on both the equity and the debt side has been better. And the fee business, particularly wealth management, has been helped by the rebound in the markets. The laggard there is really M&A. Investment banking has been slower in that sense. But I do think the bar has been lowered pretty much, that banks should be able to beat estimates. The results should be up sequentially quarter to quarter, but obviously are still going to be down sharply on a year-to-year basis.